So I'm writing two little letters underneath here. EH under here, expectations hypothesis. What I've just given you here is a story about how, in order to facilitate this imbalance in payments, okay, term rates are a bit up above their what you would expect from the expectations hypothesis. But that's exactly what we observe in the world. That's exactly what we observe in the world, is that term rates are higher than you would expect them to be, as if you were just rolling over. The term structure tends to be, it doesn't tend to be flat, it tends to be upward sloping on average. So here's a story about why. Here's a story about why it's upward sloping. It's creating an incentive for dealers. Dealers have to make profit in order to make markets, and this is where the profit comes from. This is where the profit comes from for one kind of dealing. Okay. But this diagram shows deviations from the other thing, uncovered interest parity. Uncovered interest parity says you should expect that the forward rate, okay, is equal to the expected spot rate. Okay? And now we saw how, but if it was, no dealer would ever do this trade. Okay? Because it's risky and there's no expected profit. Why would I do it? I'm just going to sit on my hands. I'm not going to do it. Okay? If you want me to do this, the forward rate had better be different than the expected spot rate. That is to say, uncovered interest parity must be false. Okay, it must be false, or else you're not going to get dealers making markets in order to facilitate this kind of trade. Okay, so here you see what I said at the beginning we were going to see, which is the failure of uncovered interest parity and the failure of the expectations hypothesis of the term structure are sort of the same thing, in the sense that both of them you can rationalize as coming from the need to mobilize profit-making dealers of two different kinds, okay, to handle imbalances in payments internationally.
So if we were to sign on to a terminal right now, we notice that the yield curves are inverse of normal. So the longer-term spot rates are lower than the shorter terms. Would that mean that the matchbook dealers are maxed out on their liquidity and the speculators are the ones that are bidding?
Okay, well that's a complicated question. So is that true what you said? If you log onto your terminal, is that actually empirically true today?
I looked at the repo market 2 weeks ago and I saw that they had an inverse yield curve.
Okay, so you're talking about an inverse yield curve in interest rate space. Okay, that you're not talking about forward rates, forward exchange rates being below current spot rates. Usually when you see inverted yield curves like that, okay, it's a sign of monetary tightening of some kind, okay, that a central bank is pulling up the short rate. But if this is repo rates, things are a little weird in repo at the moment because of collateral shortage and things like that. I think this is probably, this particular phenomenon you're noticing is not related to the argument that I'm making here. I think it's about collateral shortage. The fact that you say it's in the repo market suggests that to me. I'm sorry? So if you did see it in this market, well, whenever you see inverted yield curves, it is definitely a sign of severe stress in the money market, because that means people are bidding for spot money, okay? And they're bidding a lot of money for spot money. And the reason they're doing that is because they have payments they have to make, okay? And they are willing to pay 20% overnight interest rates, okay, in order to just roll that problem into the next day, okay? Typically, central banks don't let that happen, okay, unless they want to. You know, they sometimes want that to happen. They want to cause stress, but they will put a lid on that. They'll put a cap on that, because if you're unable to borrow, it winds up they're borrowing from the Fed, and so you don't really want that to happen. So you don't see overnight rates spiking unless the Fed allows it and wants it to happen, which they sometimes do. And those overnight rates, just through term structure arbitrage, you know, are going to pull up the 1 week, they're going to pull up the 1 month, and then as you get into longer horizons, you're not dealing with liquidity anymore. You're not dealing. What's determining those prices is something else. Okay, that's liquidity pressures that are pushing around the short end of the term structure. And that will show up in everything. During the financial, in foreign exchange as well. Okay, during the crisis, the pressure for rolling dollar funding. Okay, the need to roll some dollar funding was so strong, and no one wanted to be on the other side of that contract. And so people were saying, well, if I can't fund myself by borrowing in the Eurodollar market, I will borrow in yen, and then I will do a foreign exchange swap, and I'll fund myself that way. And so it got spread over the whole world. Okay, this crisis in dollar funding markets became a foreign exchange crisis, and in fact, covered interest parity broke down during this period. Because there was just too much stress. People stopped doing the arbitrage. They looked after themselves. This was a quite interesting experiment. The BIS has a beautiful article about that I've used in teaching, the breakdown of covered interest parity. So I'm not trying to talk here about crisis. I'm trying to kind of give you a story about the normal situation, okay, and why in normal situation you would still expect prices to get pushed away from what you would expect they would be if there were no liquidity premium. So the abstraction from liquidity, which is the standard economist assumption in order to make our models go, okay, means that you don't have a story about why the expectations hypothesis fails. It means that you don't have a story about why uncovered interest parity fails. You can make one up. You can say, oh, it's because there's time-varying risk premia or something like that. Okay, but that's just yeah, of course it is. Okay, but what is that risk that you're talking about? Okay, what is that risk? And I'm saying in this way of thinking about the world, it becomes clear what that risk is. That risk is exposure to turnover risk, to liquidity risk, to funding risk. And it's going to be time varying. Of course it's going to be time varying because it depends, it's going to change over time depending on the pattern of payments. Sometimes the payments are going this way, sometimes the payments are going that way, sometimes there's really big imbalances, sometimes they're very small imbalances. If there's very small imbalances, you would expect these premia to be very small. You wouldn't, they would disappear because there's no reason for them. There's no reason for them. You don't have to incentivize dealers to take these risks on their balance sheets. So you definitely would expect these premiums to be time varying, but they're time varying in this way of thinking about the world, not because people's utility functions are bouncing around, that they have time-varying risk preferences. No. It's because the pattern of payments is time-varying in a kind of random way that's showing up in pushing prices away from their fully efficient level. And pushing prices away from their fully efficient level in the most liquid markets in the world. $4 trillion worth of trading in foreign exchange every day, okay? And you see these inefficiencies in pricing. If you see inefficiencies in these markets, you're going to see inefficiencies in all markets, okay? Because it's not about volume. It's not about volume. It's about creating an incentive for the dealers to take these positions and to move the survival constraint on into the next day. Right? That's what's going on here. This is moving the survival constraint of the deficit country on into the next day. Because tomorrow, it could be that the trade goes the other way, right? That the deficit country gets dollar payments, okay? And suddenly, everything goes the other way. But this is what's needed in order to say, I don't have any dollars today, I'm going to have dollars tomorrow, okay, I think, or next week, so I would like to do this business and I'm willing to pay you dealers, okay, something in the meanwhile to help me push this survival constraint off into the future when it's going to be easier to deal with. I can push it off, you can help me, but I may have dollars tomorrow, it may be a week, it may be a month, it may be 6 months, so the dealers don't know whether this is going to reverse. And so they have to position themselves as if they're going to have to hold this position to maturity. And that's where the prices come from.